Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome to this Peak Prosperity Podcast. I am your host, Chris Martenson. Well, things just get crazier and crazier in the world, and it seems the only way to keep your bearings is to take 2 steps back and look at the big picture. And this is especially true when it comes to what the central banks are up to and the geopolitical and economic realities that are taking shape as a result of that. So, to help us take a necessary 3rd step back today, we're speaking with one of my favorite guests, Jim Rickards, seasoned financier, risk manager, and author. His recent bestseller, Currency Wars, which you really should read, is proving to be prophetic, as well as his most recent book, I'm thinking. Let me do that over again. As will his most recent book, The Death of Money, The Coming Collapse of the International Monetary System, which just came out. Very provocative title. We'll find out what he means. Now, Jim is best known for his expertise in describing how currency wars are one of the most destructive and feared outcomes in international economics, and that history shows they always end badly. Last year in this program, he warned that the world is engaging in a new currency war, posing risks that every prudent individual should be aware of. Recent central bank actions from the U.S. to Japan to the European Central Bank, or ECB, have shown that the race to debase has kicked up a few notches. Jim, welcome. Always a pleasure to have you on.
Thank you, Chris. Nice to be on with you.
Great. Well, let's start with your previous book, Currency Wars. One of the things you predicted back then was the possibility of China, Russia, maybe some other countries would respond to the new currency war by buying gold. Ridiculed at the time. Is anybody laughing now?
No, it's a very serious trend, and this goes back. The book Currency Wars, Chris, came out in 2011, but in the book I was writing about something that happened in 2009. It was the first ever financial war game. So, sponsored by the Pentagon, we had uniformed military, we had the intelligence services, people from the Treasury, people from the Fed, people from think tanks. I even recruited a few Wall Streeters that said, if you want to manipulate markets, get some people from Wall Street because they do it the best. We got down there and we launched a scenario that I devised with a few others where Russia and China would pool their gold reserves and issue a new gold-backed currency, but more importantly would say that from then on Russian natural resource exports and Chinese manufactured goods could only be paid for in this new currency. So they would turn their back on the dollar, and they said, if you want the new currency, you can earn it in trade, or you can deposit your gold side by side with theirs, and their bank would issue some of this new currency. And we had the bank in England and all that because of the rule of law, and that was important. Well, we were actually laughed at by some of the, I have a lot of respect for Harvard, but some of the Harvard heads and think tank people were, don't you know gold is not part of the international monetary system and it never will be again, and this is ridiculous, and what are you doing? Well, since then, Russia has actually increased their gold reserves by 70%. China has increased their gold reserves by several 100%. No one knows the exact number because they're not transparent about it, but we have enough data from mining output and Hong Kong imports as well as other information sources to estimate reasonably that China has, let's say 3,000 or 4,000 tons, but certainly multiples of the 1,000 tons they officially report. So China and Russia have done exactly what we say, which is basically increase their gold reserves, and they're acting more and more in concert. I was, even though we did this scenario, I was shocked to learn recently, Secretary Hank Paulson, who was Secretary of the Treasury during the financial meltdown in 2008, he did an interview with the BBC, and he said that during the crisis, so 5 years ago, when he called the Chinese to reassure them, don't worry about the Congress, in effect, we're going to guarantee everything. And the Chinese said that the Russians had contacted them and talked about dumping their Fannie Mae stock and bonds together. Of course, they both, China and Russia both have Fannie Mae and U.S. Treasuries and other instruments in the reserve positions, and dumping them to sort of sink the U.S. once and for all. So the gold accumulation is going on, the coordination is going on, the financial wars are heating up. We see it in Crimea. Russia has taken over Crimea. Nobody thinks that there should be military intervention by the United States there. Left, right, or center. I certainly don't think that. But the U.S. doesn't want to do, appear to do nothing. So we're engaging in, economic sanctions, which is a form of financial warfare. But if we escalate, the Russians will escalate. They've already said that. The third piece of the puzzle, in addition to Russia and China, is Saudi Arabia. Saudi Arabia feels stabbed in the back because the U.S. has green-lighted Iranian nuclear ambitions. The Obama administration did that last December. There were talks underway, but they're not producing anything. Iran still has its nuclear reactors, still has its centrifuges and its uranium enrichment program. So the old petrodollar deal, where Saudi Arabia supports the dollar in exchange for us supporting them militarily, they feel stabbed in the back because we're cozying up and having détente with Iran. So they have no further reason to require that oil be paid for in dollars, and we may soon see oil paid for in euros or yen or Swiss francs or maybe gold. And so whether it's Russia, China, Saudi Arabia, you go all over the world, you see all these threats to the dollar. Now, it hasn't come tumbling down yet, but you don't have to be a scientist to see this coming. This is like snow building up, and you know the avalanche is coming, you don't know when, but it's very plain to see, very apparent.
Jim, what's interesting in that to me is obviously, the United States is flexing what muscles it can over the Crimean situation and seems to only be driving Russia that much closer to China. And also with Iran, there have been deals inked on both sides with all those parties. And what's coming increasingly clear is, this is being presented in the West as if, oh, look, it's red team versus blue team. It's the good guys and the bad guys. It's Russians this and Americans that. But aren't the things that Russia and China are doing really just what a prudent, dispassionate investor who sees the United States printing billions and billions, tens of billions every month in QE and failing to get its fiscal situation in order? Aren't these just prudent actions really on some level, or do you think they're really just are swamped by the geopolitical us versus them realities?
Well, it's really both, but I think you make a very good point, Chris. And China is a perfect example. China has $4 trillion in reserves, all that almost all that in paper assets, and the vast majority of that in dollar-denominated assets, mostly U.S. Treasuries. There is no bigger fan of the dollar than the Chinese. Now, we know that China is acquiring thousands of tons of gold. We talked about that a little bit. And a lot of people speculate, China is acquiring the gold because they want to launch a new gold-backed currency and knock the dollar off its pedestal and all that. That's not actually the reason they're doing it. They may have to do that in an extreme case, but that's not what they want. China's a big fan of the dollar. If I had $4 trillion of paper, I'd want a strong dollar too.
Yeah.
But they look at the United States. They see the United States trying to cheapen its currency, trying to cause inflation. 10% inflation in the U.S. dollar is a $400 billion wealth transfer from China to the United States because their U.S. dollar paper is worth less, and we have to pay them less in real terms. So what they're doing with the gold is they're actually creating a hedge. And let's say they have 4,000 tons. That's worth about $200 billion, a little more at the market. And so, okay, so we have 10% inflation, and it knocks several $100 billion off the value of the reserves. But that kind of inflation would cause gold to double or triple or maybe even more. So what they would lose on the paper, they would make up on the gold. So in effect, they want a strong dollar, but they know we're trying to cheapen it, so they're buying gold as a hedge. And that's what any investor can do. And so I look at the Chinese buying thousands of tons of gold to hedge their paper dollar positions, and I say, well, are they stupid, or do they see something coming that we don't? Well, they're not stupid. The Chinese are not stupid. So my advice to investors is, if it's good enough for the Chinese, it's good enough for us. Every investor should have, about 10 to 20% gold. I don't recommend all in. I do not recommend 100%, but you should have at least 10% of your investable assets in gold. If it's all good and nothing bad happens, you won't get hurt and your other assets will perform well. But if we have the kind of collapse, which I do expect, you'll lose a lot of money on the paper, but you'll make a lot of money on the gold. That's kind of your insurance.
Well, now that's a strong word right there, and it's right in the title of your new book. What do you mean by the collapse of the international monetary system? Do you mean that literally?
Well, when I say, that's the subtitle, The Coming Collapse of the International Monetary System, the main title, of course, is The Death of Money. When I say that, it's not meant to be a provocative statement. The international monetary system actually has collapsed 3 times in the past 100 years, in 1914, 1939, and again in 1971. So it's not a rare event. It does happen every 30 or 40 years, and by the way, it's been 40 years since the last one. By collapse, what I mean is a generalized loss of confidence in the paper money, or government's ability to, in effect, steal your wealth by creating inflation in paper money. Either way, if you're relying on dollars, let's say, because you have an insurance policy, an annuity, a retirement check, Social Security, anything where you're relying on any kind of fixed amount of dollars, you're extremely vulnerable to inflation. And 10, 20% inflation is just like the stock market going down 20%. It's you lose that wealth. And so when people lose confidence in the dollar and they no longer consider it a store of value, they get out of it. Now, even you may be making dollars, but you want to dump your dollars. You want to go buy gold or silver or land or fine art or energy assets. And by the way, the biggest guy doing this right now is Warren Buffett. He's known as the stock market guy, but a couple of years ago, Warren Buffett went out and he bought the Burlington Northern Santa Fe Railroad. Well, what is a railroad? It's all hard assets. It's land, right-of-way, mining rights adjacent to the right-of-way, rail, rolling stock, signals, switches, yards, buildings. It's all hard assets. How does a railroad make money? It moves other hard assets, so coal, wheat, corn, steel, et cetera, in the form of freight. So buying a railroad is the ultimate hard asset play. It's a hard asset that makes money moving hard assets. So when I see Warren Buffett do that, what I see is a guy dumping paper money, getting into hard assets. Now, he wouldn't say that, but I always say, watch what they do, not what they say. So for everyday investors, maybe we can't afford to buy a whole railroad like Warren Buffett, but we can put some of our assets in gold and accomplish the same thing. And so that's the insurance element of it, and the collapse is a loss of confidence. And when that happens, you're going to want to have these hard assets. And now's the time to prepare for it, because it may be too late, because this could come very quickly.
So by hard assets, railroads being one, some gold you've mentioned. What sort of other plays are you advising people take a look at right now?
Well, actually, my best performing asset the last 5 years, gold, is my second best. My best performing is fine art. And there, you see a guy, some of these multi-billionaires go out and buy a Picasso for $150 million. And you say, well, I can't afford $150 million for a Picasso. Well, very few of us can, but the point is there are some funds. You have to be careful. You got to pick the right managers, but there's some art funds where you can pool your assets, and the manager will buy the art and manage it and sell it and produce those kind of returns. But I like to say fine art behaves the way gold would behave, but for central bank manipulation. In other words, clearly central banks do manipulate gold, and I talk about this and give evidence for this in my new book, The Death of Money. But Janet Yellen doesn't care about the art market. So the art market actually performs like gold without the central bank squashing it every now and then. So it's a good asset. Land is another one. As I say, there are a number of things you can do in addition to gold.
Well, let's talk about that for a minute, because I get this question a lot, which is, what is different this time is that there's no border to duck over. You're mentioning fine art as potentially a virtual border that we could go over. But if you're like, this is a game of elephants at this point in time. So let's pick something. I'm the sovereign wealth fund for Norway, right? I've got some stupid amount of money. I've got nearly $1 trillion that I'm got to do something with. And suddenly I get concerned about the idea that there's this big currency war and the international monetary system might collapse and a new one be born. What do you think those players are going to be doing in the face of this information?
Well, if you have, the Sovereign Wealth Fund of Norway, they've got several $100 billion, and when you have that much to invest, there's kind of not enough gold in the world at these prices. I mean, if you went out to buy even 10% gold, you'd probably double or triple the price. So that's pretty clear. I mean, they diversify. They buy a lot of fixed income investments. But, if you're Norway, you have to ask yourself, should you leave the oil on the ground if that's feasible? And, maybe that's your best store of value, just keeping the oil, and it'll be worth more down the road. But, they operate these things along very conventional lines. I happen to be familiar with the Sovereign Wealth Fund in Norway. It's very heavily diversified. They don't take any active positions. It's just a large, kind of index fund of stocks and bonds. China Investment Corporation, the Chinese Sovereign Wealth Fund, they're a little more concentrated. They buy hedge funds and do some other things. But with those kinds of pools of capital, they're almost too big to be nimble. But that's not true for individuals. Individuals, I think, can seek out some of these alternative investments, and there's a place for stocks and bonds. But even if you're going to have stocks, you'd want to look at transportation and energy and some of the fields that are linked to hard assets. Then you can buy hard assets themselves, as I mentioned, such as land, gold, and fine art. People talk about gold at say $1,300 an ounce, and I My forecast is that it will go much higher for some of the reasons we've talked about. But, Picasso is sort of $500,000 an ounce. So if you think of it, just, weighs a couple hundred, it costs a couple $100 million, and it only weighs a few pounds. So you do that math. And by the way, in the United States, when we talk about the old money, we talk about family fortunes that are maybe 100 years old. But when you go to Europe and talk about the old money, this is dynastic wealth that's been around in some cases for, 400 or 500 years or even longer. They've had to survive, the 30 Years' War and Napoleon and Louis XIV and the French Revolution and World War I and World War II and all that. And you talk to them and say, well, how did your family preserve wealth for, 400 years? And what they tell you is a third, a third, and a third. And what they mean by that is 1/3 art, 1/3 land, 1/3 gold. And then some cash on the side for your jet or your yacht or whatever. And so, you're in your castle and some general is burning down the next town. He's heading your way. You can take your art off the wall, roll it up, stick it in your backpack, put your gold coins in a purse, hop on your horse and ride away, and come back a few years later when the dust settles, put your art back on the wall, put your gold coins on your table, reestablish title to your land. You're good to go. You're as wealthy as ever, and all your neighbors have been burned out. So there's something to this kind of investing because it really preserves wealth in very adverse conditions. So if you think everything's fine, then, be happy with your cash. But if you're concerned that there's massive instability and we're facing a catastrophic level of collapse, and by the way, there's good, this is not just speculation, there's good science behind this, and I discuss that science in my book, The Death of Money. So I give the reader a lot to go on. I help them, I actually give them the toolkit. You can disagree with it or you can debate it, but I will give all the information, the history, the analysis, the science that you need to understand it. And if you see that coming, you'd want to have some of these types of assets.
Well, Jim, I found Currency Wars was just a very, very good description of the last 3 years. It came out in 2011. Here we are in 2014. Did a very nice job. The Death of Money is what's that? Is that going to help people understand what's coming over the next 3 years?
I think it will, Chris, and it was written that way. In Currency Wars, there was some description of what was coming, and again, we talked about that in the War Game chapters. But a lot of Currency Wars was history. There were 5 chapters of history, and I thought that was important because I knew that I wanted to talk about gold. But you know as well as I do that if you jump right into gold, people ridicule you. They call you a nut job or a gold bug, or they don't pay attention to you, etc. And I thought, well, if I can tell the story through history, let the reader understand that gold has been a part of the system for a long time. It was not that long ago, only 43 years, that the United States went off the gold standard. If you're a certain age, you remember. I certainly was a student in the days of the gold standard and had to study it in economics class. It hasn't been taught in 40 years, but it was taught when I was in university. And so if you could understand it that way, then when you talk about it in the modern context, it doesn't seem quite so exotic. So now what's different about my new book, The Death of Money, it doesn't have as much history. It certainly has some. I find that valuable. But because I told that story in Currency Wars, I didn't think I needed to repeat it. But what I did want to do is take the story forward and give investors a very good, detailed look at what's coming and what they can do to preserve wealth. So it is a sequel in that sense. I do have some history, though. I talk about, in case the readers or listeners are interested, how Charlemagne in the 9th century A.D. actually invented quantitative easing. Charlemagne's kingdom, like I say, in the 9th century, was on a gold standard, but there was very little gold in Europe at the time. And so the gold standard was something that had come out of the Roman Empire. So he switched to a silver standard, still a precious metal, but there was a lot more silver around. So that was a form of quantitative easing, because when you switch from gold to silver, there was just more money, and that actually led to some economic growth and expansion in his kingdom. So I call Charlemagne the father of QE, but he wasn't doing it. He wasn't doing it with paper. He was doing it with silver, and silver is still a good store of value.
All right. Well, as you look forward the next 3 years, what do you see coming? Are you predicting or seeing that this game changes to a new phase, the Death of Money? Is that coming in the next 3 year window, or do you see this playing out over a longer time frame?
No, I think 3 years is about right. I mean, it's not necessarily going to be tomorrow. It could be tomorrow, by the way. The system's unstable enough, but it doesn't mean we're going to get that catalyst tomorrow. But this is not a 10-year forecast. I mean, I don't think we're going to make it 10 years. I think, 3 to 5 years is about the right time frame, maybe shorter. But the reason for that, again, it is scientifically based in terms of the scale of the system. And by the way, you go back and look at these crises. They come thick and fast. I mean, memories are very short. I think we're all fighting with the 2-second, what I call the 2-second attention span. But October 19th, 1987, the stock market lost 22% of its value in one day. That would be like a 3,200-point drop in one day. In 1994, we had the Mexican peso crisis. In 1998, the Russia long-term capital management crisis. And I was involved in that, by the way. I was the general counsel of long-term capital management. I negotiated that bailout. And I know how close the world came to complete economic collapse. In other words, every stock and bond market in the world would have been closed on September 29, 1998, if we hadn't finished that bailout the day before. That's how close we came. Just because it didn't happen, people kind of forgot about it. I think it was a small event, but trust me, I was there. That was a very near catastrophe. In 2000, we had the dot-com collapse. NASDAQ dropped 80%. 2007, the housing market collapsed. 2008, the Lehman Brothers panic. So these things keep happening. But here's the problem, Chris. The Fed has printed almost $4 trillion to put out the fire from 2008. What's going to happen if we had a liquidity crisis next month or next year? They're at the limit of their balance sheet. They're already insolvent on a mark-to-market basis. And again, that's not guesswork. I actually was told that by a member of the Federal Open Market Committee. They're leveraged 80 to 1. They can't do more. They can't print another 4 or 8 trillion. They're at the limit of confidence. They're not at the legal limit, by the way. Legally, they could do it, but they're at the limit of what people will really trust or before the Congress would intervene. So the next crisis is going to be bigger than the Fed. It's like they build a 5-foot seawall, and here comes a 40-foot tsunami. There's only one clean balance sheet left in the world, and that's the IMF. So the only way you're going to re-liquefy the world in the next liquidity crisis is by the IMF printing their world money, these special drawing rights or SDRs, and that's going to be the end of the dollar as a global reserve currency, because if the IMF is going to print SDRs to re-liquefy the world, they're going to need permission from China and Russia and other members of the IMF. The U.S. Has a big voice of the IMF, but we don't control it, and so that really is going to be the end of the dollar right there. We may still have dollars. In fact, we will, but it'll be like a local currency like the Mexican peso or Turkish lira. It'll just be walking around money, but it won't be used for the important things in the international monetary system. This you can actually see coming. You can see these developments coming.
And you think that it's always been my perception that the IMF, kind of housed in Washington D.C., is a little bit of a U.S.-centric sort of an organization, if not a lot. You think China would really go along with that?
I think China would favor it, because the alternative is, perpetuation of dollar hegemony. It would almost be to say, well, no matter what the United States does, no matter how much we print, what deficits we run, what trade deficits we run, no matter how reckless we are, we can always, print our way out of it. And there's a limit to that. So China would actually like to see SDRs. There's a lot of talk about, again, China making their currency the yuan, a global reserve currency. That's not even close. I mean, they're very, very far away from that. And they don't want that, because they'd have to open their capital account. They would lose control. But they wouldn't mind seeing the SDR as a global reserve currency. They just don't want the dollar. But they're stuck with dollars for the time being. But the next panic, when the IMF has to use SDRs to re-liquefy the world, I mean, China's going to have a big voice in that. You can say it's U.S.-centric, but the problem with the U.S. is that the Treasury and the White House want a weak dollar. I mean, what good does it do you when your own country wants to trash the currency? What happened to the strong dollar policy of Paul Volcker and Ronald Reagan? And by the way, that was bipartisan. The strong dollar policy started with Volcker and Reagan, but it continued through the Democratic administration of Bill Clinton and Secretary Bob Rubin, and again, both Bush administrations. It wasn't until January 2010, when Obama declared the currency wars in the State of the Union address, he called it the National Export Initiative. But the strong dollar standard wasn't really abandoned until 2010. So that did last through Republican and Democratic administrations, and it served the world very well. But that's over now, and we're in the currency wars. And that's going to lead to a collapse, and ultimately we're going to see either gold or the SDR as the new store of value on a worldwide basis.
Now, what you're talking about here is a day of a moment of reckoning, a period of time, could be years in the making. But the macro analysis that I've got just shows me that we've been compounding our total credit in the OECD countries by roughly 8% per annum for the past 40 years. And you've got headline nominal GDP growth less than that, nominal, real growth less than that, right? So this is what you're really talking about here is to get back to your avalanche, your snowflakes on the cornice analogy. What we're really talking about here is that there's been decades of excess that are sort of piled up. They've created imbalances, a lot of potential energy. And you're saying that somehow we get back to level, like that all of those claims that have been built up, they have to be debased by one process or another. It's inflation or deflation. They either burn through the process of default or they burn through the process of debasement. Which way are you? Is that about right?
That's exactly right. That's exactly right. The debt has to be destroyed, which means there are going to be massive losses. And there are two ways to destroy it. One is deflation, which we saw in the 1930s, in which case borrowers, the real value of debt goes up. It becomes too much of a burden for borrowers, and borrowers just walk away. They don't pay it. They file for bankruptcy. They walk away. They tear it up. Or inflation, in which case the borrowers actually do pay it back, but the money's not worth anything. They're both ways they're just different ways of destroying wealth. They have different winners and losers, by the way, and that's why investors have to be nimble. One of the things I like about gold, by the way, is that it performs well in inflation and deflation. Now, the inflation side is pretty intuitive. People get that. You say, oh, yeah, if inflation takes off, the price of gold is going to go up, and that'll preserve wealth, and that's true. But they don't see how it performs well in deflation. But the answer is deflation is a central bank's worst nightmare. Governments actually cannot tolerate deflation because it, first of all, it destroys the banks. And don't ever think that the job of a central bank is to help the economy. Mm-hmm. The job of a central bank is to help the banks. And so when you have the kind of deflation that makes the real value of debt goes up and people default, where do those losses fall? Well, they fall on the banks and the lenders, and so the Fed doesn't want it because they're in business to help the banks. It also destroys tax collection. Just to give you a very simple example, so let's say someone makes $100,000 and they get a 10% raise, so now they're making $110,000. So that's a real increase in their standard of living, but the government takes about half. The government takes about half of that $10,000, so you really only get $5,000. But imagine another scenario where you make $100,000, you don't get a raise, prices go down 10%. So you're making the same $100,000, but the cost of everything you buy went down 10%. So you have the same 10% increase in your standard of living because everything you buy is cheaper, but the government can't tax that. In other words, the government can tax inflationary nominal gains, but they don't know how to tax deflationary real gains. So for all these reasons, basically the government can't tax it, the banks are the losers, et cetera, and it also hurts our debt to GDP ratio because debt's still going up even if GDP contracts, which it will in nominal space if you have deflation. So for all those reasons, central banks cannot tolerate deflation. So what does it mean when they're trying to get inflation and it doesn't work? And that's the situation we're in now. The central bank's been trying for 5 years to get inflation. They cut interest rates to zero, QE1, QE2, QE3, Operation Twist, currency wars, forward guidance, nominal GDP targeting. They've tried everything and it's not working. Well, there's one thing that always works. You can devalue your currency against gold because gold can't fight back. In the currency wars, if I devalue against China, China can fight back and devalue against me. But gold can't fight back because you can't print it. And so when countries get desperate enough in deflation, they'll devalue the dollar against gold, which means gold goes up, even in deflation. That's exactly what happened in 1933 and 34. In the middle of the Great Depression, the longest sustained period of deflation in American history, gold went up 75% from $20 an ounce to $35 an ounce. So that's an example of how gold does well in inflation and deflation. So it's a good hedge for these uncertain times.
Do you have any fears that, as gold becomes, let's say, more obviously essential to the Western economies, that they will do what Roosevelt did in 33 and say that's ours? We need that to satisfy our banker friends?
Well, look, you can't rule it out, but I think it's unlikely. And the reason I think that is because, in 1933 it was a different world. People actually trusted the government. They were desperate. They believed what the president said. They felt like we were all in it together, and if that was a sacrifice, so people kind of went along with it. I don't think any of that's true today. I think that people don't trust the president, and there's probably good reason for that, not just this president, but a lot of recent presidents. So I would make that more general. They don't believe what the government's telling them. We're not all in it together. We're picking winners and losers. The government is helping the banks and hurting everyday citizens. So for all those reasons, I think there will be a lot more resistance. The government probably knows that and probably won't go there. But, you might see other things, kind of what I call a neo-fascist response. We see militarized police and drones and NSA spying and the IRS being used for selective enforcement against political enemies. So there's a whole sort of neo-fascist toolkit that you have to be aware of. But again, probably all the more reason to have gold.
Right. So to get back to the central point then of obviously there will be winners and losers, deflationary versus an inflationary outcome. When people ask me, what are we experiencing? Which is it? And I say the answer is obviously yes. We're experiencing both, right? There's elements of deflation right now. There's elements of inflation. If you know where to look, it's pretty obvious. So in that battle, which do you see ultimately prevailing?
Well, very good question. I mean, the truthful answer is it could be either one. I think in the end of the day, probably inflation prevails. But we may have a scenario where we actually have all figures. In addition to inflation and deflation, I also talk about collapse. But to combine all those things, you could have extreme deflation in which the government becomes so desperate they cause inflation by devaluing the dollar against gold. Then along comes the inflation, and then maybe some social instability because, they're just a mix of winners and losers, and income inequality gets worse, etc. Or you could have inflation first. Inflation really destroys capital formation. That'll hurt growth, and that could lead to a collapse, which would be deflationary. Or you could just, by printing so much money and papering this over, maybe it goes on longer than people expect, but the inequality becomes so great that through denial, delay, wishful thinking, etc., the system just collapses on its own, and then you get into social chaos and unrest and get the kind of neo-fascist response I'm talking about. So I've laid these out as alternatives, but you could actually have all three, just in different sequences.
All right. I totally understand how that could be, and obviously picking what's going to happen is a tricky business, but boy, you do a great job of just bringing the facts in and using as much science and data as can be done. So in The Death of Money, any other major predictions in there you'd like us to know about?
Well, no, I do talk about pretty much everything we've discussed, and the main thing I say is that we don't automatically have to have a gold standard. Mm-hmm. That may or may not happen. There may be other solutions, although I do think it's somewhat likely. But if we have a gold standard, it's very important to understand why the price has to be where I expect it to be, which could be $9,000 an ounce or higher. And people hear that and they think it's just some big number I pulled out of the hat to get a headline or whatever. It's not true. That is actually the implied non-deflationary price. In other words, if you go back to a gold standard, people say there's not enough gold to have a gold standard. Well, that's nonsense. There's always enough gold. You just have to get the price right. Now, $1,300 with the quantity of gold, that is not enough to support world trade and world finance. That would be highly deflationary. But at $9,000, then the amount of gold times $9,000 would produce enough money to support world trade and world finance. And so if you're going to have a gold standard, you've got to get the price right. By the way, Paul Volcker said this, and I quote him in my book at the beginning of Chapter 9. So, the listeners can, if they get the book, they can see that. But so I do expect gold to go to $9,000, not because central banks wanted to, but it may have to go there in order to restore confidence, to do so on a non-deflationary basis. So that's something I would watch very, very closely, and it would be good to have some gold in case that plays out.
Well, I guess the ratio is a third, and I'm a little off on those ratios myself, but I'm definitely in the right ballpark. So sort of got there intuitively on my own. So the book is The Death of Money, The Coming Collapse of the International Monetary System. I have not read it yet, but I will give it 2 thumbs up because I know Jim, and it's going to be a great book. Everything he produces is just worth your time. So, Jim, thank you so much for your time today. It's always a pleasure.
Thank you, Chris.